Turning now to Muni Moment, all eyes, of course, on September CPI print coming tomorrow and what could be another solid advance. And it will keep the Fed committed to rate hikes until a more clear slowdown starts to emerge. Really pleased to say that for our municipal market, implication, reaction, and impacts. Joining us now is Whitney, Senior Vice President at Appleton Partners. Whitney, always great to have you on the program. Talk to me about just sort of the huge rate volatility that we've seen and the ability and stability that you are finding within the muni market as well.
Absolutely. Thanks so much for having me. It's interesting. With this inflation, we've seen a 200 basis point rise since the beginning of the year. So there has been a lot of volatility and certainly a tumultuous performance year so far. But we're sitting here in the fourth quarter, and it seems like the market was not all that impressed with the print this morning. 0.2 over the expectation, and the muni market is actually a bit stronger today. So, so given the limited supply in the market, I think the municipal market is more focused on supply and demand dynamics than this sort of perpetual inflation that we've been dealing with.
How do those supply and demand dynamics come into play, especially as we approach year end?
They're a major part of our market, and it decouples us from the Treasury market a little bit. When we have a year like this where supply has been about 15% below last year's supply, there really is a bond grab. Despite having retail investors running for the door, we had $94 billion of outflows from funds. There has still been a shortage of bonds, so investors are still anxious to get bonds. In the new issue market, bond deals are still oversubscribed, and so that really speaks to the demand of munis.
Are you seeing better strength, better opportunities, better yield on a relative basis on the front end of the curve, given the huge movement that we've seen within the 2, 3, 4, 5-year parts?
In that short end of the curve relative to treasuries, we're not quite as strong. There's almost no bonds to be had, but we're in the 60 to 70% range of ratios with treasuries. Whereas in the longer part of the curve, the 9 to 12-year part of the curve, we're about 85% of treasuries on a 10-year basis, and that is very attractive. The volatility in the short treasuries has created a lot of volatility in that short ratio, and so that's what for our investors, we have been really finding value in that 9 to 12-year part of the curve.
We're looking at a Federal Reserve that reiterates today from those September meeting minutes that they're committed to tackling inflation, even if it means the risk of a little bit of a slowdown in the economy. Do you then start to get worried about state and local government budgets, the impact on some of those credits as well if we are looking at maybe a recessionary environment?
Well, you're right. So I think we are going to see 75 basis points at the next meeting, another 50 to give us a terminal rate of 4.25 to 4.5 to start 2023. And you're right to question credits. Right now, states and local governments are in very, very good shape. They've been practicing fiscal austerity throughout the pandemic, as well as the federal stimulus money has been helping to bulk up their coffers. So they're in a great position. Some of the credits that are a little more challenged, for example, in the hospital sector, their margins are very slim given they're having a hard time hiring, and thus they're unable to do a lot of the higher margin procedures. So I think if you're buying hospitals, I think you need to be very, very clear what you own and what they're looking at going forward.